Hi, I'm Gildas Quinquis, Chief Investment Officer at Windrose Advisors, and welcome to our quarterly investment webinar. Our topic today is hedge fund investing, and our guest is Aaron Stern, founder of Converium Capital. Converium is a multi-strategy opportunistic fund investing in distressed and event-driven opportunities globally and across the capital structure. The strategy currently oversees $700 million in assets under management on behalf of more than 150 limited partners. Before we get started, I need to read a brief disclosure. The opinions expressed in this discussion are those of the Windrose Advisors LLC team and our guest today. The opinions referenced are as of the date of recording and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Past performance does not guarantee future results. Forward-looking statements cannot be guaranteed. Windrose Advisors LLC is an investment advisor registered with the U.S. Securities and Exchange Commission. Registration does not imply a certain level of skill or training. Windrose reserves the right to modify its current investment strategies and techniques based on changing market dynamics or client needs. The information contained in this presentation is provided for informational and discussion purposes only. This presentation is not intended to be, nor should it be construed or used as an offer to sell or a solicitation of any offer to buy an interest in any fund or any other entity, which offer may only be made at the time a qualified offeree receives a confidential private offering memorandum and related subscription documents. Aaron, thank you again for speaking with us today. I'm looking forward to our conversation. But before we jump in, I'd like to quickly share your background with our audience. Aaron Stern is a managing partner and the chief investment officer at Converium Capital, a multi-strategy opportunistic investment manager headquartered in Montreal. Converium aims to deliver positive and uncorrelated returns, regardless of macroeconomic conditions, by investing in distressed and event-driven opportunities globally and across the capital structure. Prior to founding the firm, Aaron was a partner and managing director at Fairtree Partners, a multi-strategy investment firm. Prior to Fairtree, Aaron held investment roles at OSS Capital Management and Millennium Management. Before Millennium, he was an investment banking analyst in Credit Suisse's leveraged finance and restructuring groups. He earned his bachelor's degree in commerce with a major in accounting from McGill University, where he's a global expert and guest lecturer. Aaron, like many of the managers we work with, you left a large and reputable firm to start a new hedge fund. Raising a fund is no easy task. So, please tell us what drove you to launch into this adventure.
First of all, you have to love what you do. And thank you so much for having me. It's really exciting to be able to speak with you and obviously your clients. For me, I always had a passion in investing. Started off very, very young in my teenage years. Learned a lot along the way. In fact, one of the companies I invested in as a teenager was a company called Converium Holdings, hence the name Converium Capital. But what I learned early on was really the value of investing or looking at a lot of companies that a lot of other folks didn't really want to look at. And professionally spent many years at Fairtree Partners, like you said, which was a fantastic learning environment where we were able to invest across the capital structure, across asset classes and geographies, and really hone in on more deeply distressed situations. Because at the end of the day, when folks are selling something because something bad has happened, it allows you to be able to acquire securities at deeply distressed prices, making it fundamentally very, very hard to lose money. And so a passion for finding things that others don't want to look at, a passion for being able to generate very good returns in all different kinds of environments, really led me to try to think of how could we create the best possible structure to be able to deliver positive performance regardless of what's happening in the world. And for many years at Fairtree, found that if I could really take a lot of the best practices, investing in situations that many other market participants either structurally can't or don't want to invest in, and really apply it to a smaller and more nimble asset base, and also marry what I was doing on the long side of the portfolio with hedges and shorts, I could create really a structure that was designed to make money in both good environments and bad. And so that's what really led me to want to, after many, many years, strike out on my own with a number of partners and create Converium Capital.
Oh, fantastic. And you chose to locate your firm in Montreal, Quebec. Were there benefits from your standpoint from taking a step back from New York as the center of finance?
Yeah, and I think it goes back to what I was saying before in terms of my prior experience at Fairtree and at prior investment roles, I really focused mostly outside of the US. Not necessarily because I like to travel, more just because what I found is that many other investors shy away from opportunities that they don't really understand. Within the US, you now have a relatively deep bench of, let's say, kind of distressed or value-oriented managers. But outside of the US, what you tend to find are generally more, I would say, geographically focused or concentrated managers, and more growth and less so kind of distress or value-oriented managers. As a result, when something becomes more challenged, especially outside the US, there are very few managers that are well equipped from a structural perspective to be able to invest in those kinds of things. And so leading that effort at Vertree, investing mostly outside of the US in those types of situations, what I found the biggest challenge was being geographically based in New York. A lot of the team that I was working with and the broader investment community tend to have maybe a little bit more of a US-centric view. And so to be able to some degree step out of that kind of finance-centric mold and also step out of that kind of geographically centric or US-centric mold, I think has been very helpful. And so, having one foot in the ground with an office in New York, my partner, Elliot Ruda, who worked with me for many years at Vertree, and also a number of other colleagues based in New York. So having one foot there and having a lot of partners that we deal with from a counterparty perspective in New York, but also having the bulk of the investment team, my partner Michael Rapps, myself, and the rest of the team in Canada really helps, I think, from a kind of framework perspective, be a little bit more contrarian.
Yeah, no, it helps you develop a very unique perspective. So you hinted that Converium pursues a broad scope of strategies to deal with the changing economic environment. Please tell us a little more about the various strategies that you pursue in the fund. Help us understand Converium.
Sure. So at its core, the way we believe we can deliver strong returns regardless of the market environment is to really, on the long side of the portfolio, focus on buying into capital structures where many other market participants either can't or won't invest, and pairing that with shorts and hedges that are designed to take the market risk out of the portfolio. So on the long side of the portfolio, that's a range of different sub-strategies, right? Because different market environments really lead us to different types of opportunities. So in some cases, we can find more deeply distressed situations. This is, in some cases, buying government debt, either issuers, sovereign or quasi-sovereign issuers that are undergoing a restructuring, potentially need to restructure their debt, where we can acquire bonds at 20, 30, 40 cents on the dollar, where a worst case scenario is already being priced in, or we can acquire bonds or loans of public or private companies that are either going through a restructuring or are being priced as if they will go through a restructuring. Those tend to be the more significant components from a return perspective in our portfolio because we're buying debt at such a deep, deep discount to its fundamental value. However, as you can appreciate, certain environments have much more distressed opportunities, others less. So it's a constant component of our portfolio, but in varying weights depending on the market environment. Now, another component of our portfolio are more stressed or opportunistic credits. Now, these are finding situations where a company doesn't have risk of impairment or restructuring, but for whatever reason, their securities are being mispriced. It could be a legal overhang. It could be a business portfolio issue. It could be something related to the geography or industry that that company operates in. Or it could be something structural, like, it could be a wacky securitization that isn't very well understood. These tend to be capital structures that are largely outside the US, tend to be smaller, under a few $1 billion, so less eyeballs on them, which really allows us to be able to acquire performing debt at 40, 50, 60, 70 cents on the dollar, pretty material discounts to par value, yet own instruments that we feel can deliver those significant double-digit plus type returns because they're orphaned and have sold off for a reason. Another component in the strategy is really relative value credit. So in certain environments, there's more distressed opportunities, others more stress credit. Another area where I'd say there's kind of a constant stream of opportunities is really relative value within a company's capital structure. So this is a very nice tool because in many cases we find companies that might have a significant issue, which is weighed down on the capital structure. But unlike some of the other situations I discussed, there are opportunities to create effectively a riskless trade within the capital structure where we can go long the senior debt of a company and go short its subordinated debt, or go long senior debt, short the equity, or maybe even go long the equity, short the debt. The value there is that there's a company that's been orphaned, dislocated for a reason, which leads to basically a broad sell-off of all the company's securities, leading to a significant mispricing where we're able to isolate that intra-capital structure mispricing without taking any market risk, and in many cases, even isolating the company risk.
So we covered a lot of topics with that, but one feature that jumps out is the fact you have such a large toolbox to work from. And tell us maybe where the portfolio has tended to lean in an environment that didn't see a whole lot of distress and dislocations.
Sure. So at its core, we're looking for situations where we can understand that there's a fundamental mispricing. We see and we understand why the opportunity exists, and we know that we're acquiring the securities at a deep discount to their fundamental value. Now, in certain environments, we'll find obviously a lot more distress. I think the challenge that we've seen over the past number of years is, even though there have been a lot of macro headwinds and vulnerabilities, the amount of distressed opportunities that we found in credit markets has been, I'd say, a little thinner than we would otherwise expect. Now, that being said, the advantage of a broad mandate means that in every environment, there's always things to do, right? And so being able to pivot to different geographies, different asset classes, means that we can always find something. And the portfolio is really geared towards the best possible ideas, regardless of that environment. And so I talked before about distressed or stressed sovereign debt, quasi-sovereigns, corporates. Having those different tools in our toolbox means that whatever the environment throws at us, we can always find opportunities to populate the portfolio with. Another interesting component of the team and the strategy is really our ability to create a catalyst. And so as you can appreciate with a lot of these smaller capital structures, they could languish for some time. The value's there, but they could languish for some time. Now, how do you unlock that value that's there? In many cases, it requires an effort either to roll up your sleeves and engage from a governance perspective, a capital structure perspective, or even from a business portfolio perspective. And so my partner, Michael Rapps, who's run a number of public companies, myself, having led a number of restructurings and activist engagements in a variety of different sectors, we really bring those tools that are able to find the right tool for whatever situation we're in. And just to kind of like to go in a little bit more on that, what we find is we talked about distress situations. Now, oftentimes, companies might have debt that trades at a deep discount to their fundamental value. And the fundamental value, in some cases, is the operating business. In other cases, can be a significant amount of assets that do not contribute to the earnings of that company, right? Could be real estate, could be interest in other businesses that might not be productive, but certainly has a significant amount of value. So being able to engage with the issuer and in many cases use those, let's say, kind of non-operating assets as a source of value to pay down the debt or to basically take the debt from the operating business and novate it towards the non-operating assets really allows us to find a creative solution that works with the issuer, that also works with a number of other holders of those instruments that are looking for a path forward, but in those cases are not really willing to roll up their sleeves.
Yeah, it's really a Swiss Army knife portfolio. So many tools you can lean on. Now, there have been some prominent bankruptcy headlines in the market. Do you think this holds sort of a rising wave of distress in credit markets? And is that something that would help your strategy?
Certainly. So more distress, more defaults, I think creates a very interesting environment for us. What we've observed over the past 5 years has been a massive wave in debt issuance of privately owned businesses. Now, some of them are sponsor-backed companies. Others are just businesses that are not publicly listed. And the amount of debt today in leveraged loan indices and in the high yield market of private companies has really ballooned to, on aggregate, be more than half of those indices. Now, why that matters is, unlike public companies where there's a lot of publicly available information, in these cases, there's a lot more opacity around what information is provided to investors, reporting requirements as well, especially if the only debt in the capital structure is a loan. And so what ends up happening is, a lot of this debt gets kind of stuffed into portfolios with a lot less attention being paid to them because there's no analyst coverage, there's a lot less information that's available. And, what that means is really, it kind of sets up for a lot more, let's say, negative surprises, if you will, because in many cases, these companies have a significant amount of leverage. A lot of that leverage was put on in environments where interest rates were around zero, and more importantly, where inflation was around zero. And the challenge that a lot of companies today are facing, especially more highly leveraged ones, is not just that it's very challenging to service the debt because interest rates are higher than they were 5 years ago, but also because a lot of companies now need a lot more money to manage their businesses. So working capital needs have really ballooned because we've crossed the Rubicon in the world of inflation being no longer zero or negative, meaning that companies are facing significant liquidity needs that can arise suddenly because of tariffs, because of other supply chain considerations, because of inflation just generally. And that means that all of a sudden, companies that thought that they could run with a certain amount of leverage now need to run with less financial leverage because they need an additional cushion from a liquidity perspective to be able to operate their businesses. So our view is the combination of companies that maybe have less reporting requirements and don't need to really share as much detail on what's going on with their businesses and have less analyst coverage that are really sharing a lot of the details of the operating conditions of these businesses, coupled with emerging liquidity needs, could lead to significant negative surprises, which could lead to a wave of restructurings. Now, we don't think that that's necessarily bad for the world. We just think that there are many companies that just have way too much debt for this kind of environment, which could lead to a very long wave of, I would say, deleveraging, a deleveraging cycle over the coming years.
No, thank you. That's very insightful. A lot of the situations you describe involve buying debt at a deep discount. So that sounds very risky on the outset, but from your perspective, describe the risk reward that you face when you enter into a situation at such a discount.
Sure. I think what's very important to remember is that when we're buying into a situation, something bad has already occurred, right? the investor base has been surprised negatively. And so the price mechanism reflects that, right? Something bad happened. The folks that knew this company's capital structure very well have chosen to exit, leading to a price that generally reflects a lot of bad news and then some. And so our analysis really centers on, first of all, honing in on dislocations, right? Rather than just looking at the universe of every company in the world, and I imagine you might ask me about sourcing later, but rather than looking at every company in the world, we're trying to focus on the companies where their securities have gone down rapidly for a reason. And then we do an analysis to understand, do we have a significant margin of safety? At the level that we're buying in or looking to buy into the capital structure, are there a significant amount of non-operating assets that more than cover the value or the price that we're paying for that security today, even if the operating business continues to underwhelm? And so what we do is we basically say, this is the range of outcomes. This is what it means for a range of prices in the capital structure. And if we're buying at the low end of that range of outcomes, then we have a lot of built-in protections there, both from a legal and financial perspective. And we target situations where the upside is at least 3 times fundamentally to the downside. And so, for us, if we can identify situations that are already beat up, where we're buying at a deeply distressed price, we could get it wrong, but in many cases, even if we get it wrong, we should be able to generate positive returns.
Right, a lot of
because of the price we're paying.
A lot of asymmetry.
Exactly.
Built into those situations. So you brought up the theme of sourcing. You are, pursuing opportunities globally. How do you source your investment ideas? Where do you decide to focus?
Yeah.
How do you handle that universe?
So we run screens. We look for the losers, and we run screens. It sounds funny to say, but we run screens on a weekly basis, looking for bonds and loans that have gone down dramatically and seek to understand why. We also run other screens looking for discrepancies between equity prices and credit prices. But essentially, we're looking for bad news, right? Something bad has occurred, and we want to understand what's going on. We take that list that's been populated from our screens and basically go in one by one to see if, first of all, we're comfortable with the jurisdiction that these companies, or in some cases, countries operate in, what laws govern the debt documents, and then also to understand fundamentally what the pieces of value are between the non-operating assets, the operating assets, and ensure that we can get comfortable with, let's say, the downside from both a legal and financial perspective. And if we understand why the opportunity exists, and if we believe that we have downside protection, both from a structural perspective and from a financial perspective, then we dig in further to do our typical diligence in terms of the management team, in terms of understanding the prospective catalysts, and in terms of understanding who the other holders are, what the process risk might be.
Your process takes you to some unusual places, like countries in Latin America, places with seemingly unattractive jurisdiction like France. Yeah. Tell us what makes those investment opportunities so compelling from your perspective.
Yeah, I think it's probably a good opportunity to talk about some things we've done historically. One investment opportunity we have discussed in the past publicly was our purchase of the bonds of the sovereign bonds of El Salvador. So several years ago, El Salvador, an issuer that in recent memory has not defaulted on its debt in any form and has had very good standing in credit markets, decided to make Bitcoin legal tender from a convertibility perspective, and also purchased $100+ million of Bitcoin. They had about $5 billion of bonds, all governed by New York law, denominated in US dollars. The value of those bonds declined by almost 70%. So they lost $3+ billion in value because the country bought $100 million of Bitcoin. And so this obviously popped up on our screens as we discussed, and we dug in and understood that, first of all, at the time, we were not experts in El Salvador. But we did understand and had a long experience investing in sovereign debt. For me, in Greece in 2012, Argentina, Ukraine, I was going to say Argentina multiple times, Ecuador. So having experience analyzing sovereign debt, what we found is sometimes sovereign debt can actually lead to the most attractive opportunities because many market participants are afraid to invest in a distressed situation where the process is unclear for them. And there's no type of situation that has a less clear or more opaque process than sovereign restructurings, because at the end of the day, you don't really know how things are going to play out, especially over the short term, just given all the different stakeholders that are involved. However, what you do know is that sovereign nations are heavily reliant on bondholders to be able to finance their perennial deficits. And so there is a long history of relevant comparables where you could see how sovereigns have dealt with their debt historically. And so the lack of the process in a country that maybe is relatively small really kept a lot of investors at bay when something bad happened, which created a very interesting opportunity for us. Because we could look at the bonds at 30 to 40 cents on the dollar and look at a number of things. First of all, El Salvador does not use their own currency. They use the US dollar. So you don't have any foreign currency risk. They have a relatively stable and tight-knit banking sector. So not really any significant read-through or risk to the banking sector. And importantly, very, very sticky and stable economy that was heavily tied to the US. And then last, at the end of the day, issuers default, not because they have too much debt, but because they need money for something. And if they don't need money to bail out the banks, they don't need money to stabilize their currency because they don't use their own currency, they use the US dollar. And very importantly, they had no maturities for the next few years. You could look and say, there's really no significant cash needs over the next few years that would result in any need to restructure the debt beyond just the negative headlines and the fact that the debt went down. So we looked at it and said, okay, we can buy bonds at 30 to 40 cents on the dollar. The bonds were paying at the time 7 to 8 points a year of coupon. And the next major maturity was several years away. So if you buy a bond at 30 to 40 cents on the dollar and you're collecting 15 to 18 points of interest, between that point and the ultimate potential default, or when they, could face any material cash needs, you're effectively paying 20-something cents on the dollar, at the end of the rainbow for that debt. And when you look at all comparable sovereign restructurings, many much more complex cases like Argentina or Greece or Russia in the late 90s, where there were significant cash needs, much more complex situations, even then recoveries were higher than 20 cents on the dollar. And so the combination of the basically lack of leverage, the lack of cash needs, the extremely low dollar price that we were entering in made us feel comfortable that we were able to acquire these things at very, very silly prices. And what happened over the past few years is the bonds went from basically par to 30 cents on the dollar because a lot of investors got scared. And today, several years later, we no longer hold the bonds, but today, several years later, the same bonds are back at par. Now, they still own Bitcoin. The situation is still the same. But in the immediate shock, the combination of the negative feedback loop of prices going down, more investors getting scared, the rating agencies downgrading, can create very interesting opportunities. So sometimes the things that might seem the scariest are actually where we can acquire at the most attractive prices.
Which is absolutely fascinating. And the road less traveled is full of opportunities.
Exactly.
So talking of which, what are some of the opportunities that are flashing on your screen today? Are there any themes?
Yeah.
What are your thoughts on current market conditions?
Yeah. So it's very interesting because the environment today in stress and distressed credit, I think, is littered with a lot of private issuers that I mentioned, or also smaller public issuers. Now, in each of these cases, there's no kind of unicorn of fantastic business with a bad balance sheet. It tends to be a mix of issues where, the business has underperformed for a while. There are significant cash needs, both in the form of working capital needs and maybe balance sheet weakness. But we found is really the appetite to kind of roll up your sleeves and get involved in more distressed situations is incredibly small today, which means that when something bad happens, the clearing price for those securities is quite distressed and a fair amount below fundamental value. And so where I think we're finding opportunities are capital structures that are under a few $1 billion, many of them outside of the US, where we can acquire debt at 30, 40 cents on the dollar in businesses that I would say are not perfect, clearly have their challenges, but where there's a significant amount of value outside of the core business in terms of manufacturing facilities, in terms of maybe other real estate, interest in other businesses, and where the core business itself does have a fundamental floor, has challenges, but does have a fundamental floor. And the combination of those sources of value means that in many cases, that provides us with a buffer of higher than the price that we're paying for those securities. So I would say, again, less opportunities today in more deeply distressed, in the larger capital structures, but the businesses that are a little more challenged, where the enterprise value is under a few billion, we're finding plenty to do.
Right. If you're not afraid of the complexity, or if you're not afraid to go off the beaten path.
And at the end of the day, it's all the price that you're paying, right? And if you're buying the debt at such a deep discount in jurisdictions where there is a restructuring process and where there are assets to really protect you and provide you a floor, even if the business continues to suffer, and even in the worst case where there's significant additional liquidity needs, where debt comes in ahead of you, it's still plenty hard to lose money at those prices.
So here we've talked about, stress credit situations where you build a very asymmetric return profile, very downside protected. But in your fund, you also are very active on shorting.
Yes.
And I think that sets you apart as well. You mentioned to me before, a few funds will short credit, and yet you do. So what do you find so compelling in that area?
Yeah, I think in environments like this, where there's kind of a mad dash for yield, there's a general fear of spending that kind of precious carry on shorts. So folks would rather be long credit than short it. And what I talked about before, just in terms of a lot of silliness in the credit markets, a lot of companies that are over-levered, that have significant liquidity needs, many of them are privately owned, in which case there's not that much information that's publicly available, really creates, I would say, kind of a perfect environment to look for shorts. And so the first thing is just structurally for us, the best way we believe to hedge the market risk or to take the market risk out of the portfolio are single name credit shorts. So let me just expand a little bit on that, right? On one side, we're buying deeply distressed and stressed credits at a big discount to their fundamental value. Now, what if we can identify companies that have all those fundamental weaknesses or concerns in terms of high leverage, vulnerable balance sheet, potentially relatively weak docs or process risk in the event that they do restructure, but for whatever reason, the credit hasn't been downgraded yet, there's less eyeballs on it, whatever it may be, the debt still trades at par, right? Everyone's receiving their coupons, people are happy to own it at very, very high prices. If we can identify situations like that, it really serves two purposes. The first is that in an environment where interest rates go back up or the macro is inherently weak, that will serve as effectively the catalyst for a lot of these highly leveraged companies to unravel, right? If you're highly leveraged, you're very dependent on the macroeconomic environment, you have very thin margins, something bad happens in the world, interest rates go up, whatever it may be, all of a sudden that kind of puts you in the penalty box and exposes a lot of risks. And in that case, the value of your debt can drop significantly. Now, the nice thing is we can, first of all, generate significant returns by shorting those bonds at or above par value when they drop significantly. But also it serves to hedge the portfolio because on the long side, we have macro risk, we have interest rate sensitivity. And so if we can find names that balance that out, where, again, those negative drivers would be very, very bad for the price performance, that will serve to take, I'd say, the macro risk and the interest rate risk out of the portfolio. And what we've seen over a lot of different environments over the past 5 years is that mix of deeply discounted bonds and loans on the long side and high dollar price but still vulnerable bonds on the short side really can perform well in any different type of environment. Also importantly, you asked about sourcing. The easiest way to find opportunities are names that you already know. And if we can go short the debt of a company at a very high price and the bonds collapse for whatever reason, we have a first mover advantage. We understand the company, we understand its capital structure. We're very well positioned to go the other way if the price mechanism, corrects and all of a sudden the prices are at 30 or 40 cents on the dollar instead of 100 plus. So structurally, we always have a very significant short book. We don't tend to have any macro risk in the portfolio. So it's always a significant component of our portfolio. Now, in environments like this, where there are a lot of vulnerabilities and at the same time, credit spreads are at historically tight levels, it's an even more attractive environment for that component of our strategy. And so we're finding, I'd say, some of the most compelling opportunities that we have more broadly in the portfolio are actually on the short side, where the amount of dollars we can lose being short a bond that yields 5 or 6% is de minimis compared to the amount of money we can make if those companies need to restructure and that debt falls 40, 50, 60, 70%. So we can make 10 plus times our downside risk if these situations correct.
Yeah. So let's talk about the current market environment. And we've basically lived through a 16-year bull market in equities, very few distressed situations, nothing systemic. Do you think investors are still being compensated for the risk they take in equity and credit markets? And how does that inform how you're positioning the portfolio?
I'm not a market prognosticator. I always struggle to pronounce that word. However, I do find that our micro view, just looking at specific names, informs our macro view. And what we're seeing is, no, we don't believe investors are being compensated on the credit side. Equities is a little harder to opine on, but on the credit side, spreads are at historically tight levels, which doesn't really make sense, right? The combination of a higher base rate and historically low spreads means that maybe the higher base rate plus the spread, the all-in yield might look attractive, but it doesn't make sense that a company borrowing at an all-in rate of 6, 7, 8, 9% its debt is trading at pretty much all-time tight credit spreads. It just fundamentally doesn't make sense because their cost of borrowing all in is quite high, and we're in a higher risk environment from an impairment perspective, given many of these issuers are saddled with, unfortunately, a lot of debt. And so I think, again, now is probably the most attractive environment that I've seen in my career to be short credit, because the cost to be short is incredibly small, and the return potential, given how much leverage many of these companies face, and the write-down risk is quite significant and attractive. So
it sounds like a plentiful environment to short individual idiosyncratic credits, but do you also layer in market hedges?
Yes, it's a good question. So for us, what we're trying to do is really take out the market risk from the portfolio. Now, the ideal case is if we can find idiosyncratic credit shorts that also have market risk embedded in them, then that's a great tool to use. However, we also balance out whatever we're missing in terms of isolating market risk in the long portfolio, whatever we're missing from the idiosyncratic shorts with market hedges. Now, our goal using market hedges on the equity and credit side is really to spend a specific amount of money, a relatively small percentage of the overall carry of the portfolio, where we can isolate, let's say, kind of like the beta in credit markets. And so in some cases, that could be a larger, more liquid sovereign or corporate credit issuer, single name issuer. In some cases, it can be options on various indices. It really depends. But again, we're balancing out whatever market risk is left over that hasn't been addressed from our idiosyncratic shorts with market hedges.
Let me ask you this broad question, but what are the risks that keep you up at night? Is there a canary in the coal mine that you're looking out for?
Yeah, I think we're in an incredibly uncertain time. And I think what's very odd is we have a significant amount of macro and geopolitical risks at the same time that credit spreads are all at all-time tights. So the combination of the market pricing in everything good with a lot of risks on the horizon is quite concerning. Now for us, again, on the long side, making sure that we're buying into things where we understand why the opportunity exists, their idiosyncratic situations, and hedging out the market risk means that, again, in any environment, we should be able to generate very good absolute returns. However, we want to make sure that we're not chasing things that don't make sense. And so we do have the flexibility to sit with a bit of cash when the market environment dictates that. And I'd say in our environment like today, both our gross exposure and our net exposure is lower than it's been historically. We have a decent net short position, as we've discussed in the past, about 15% of fund assets. And from a gross perspective, have plenty of liquidity that if markets do wobble a little bit more, we'll be able to pick up a lot more opportunities. So I think in terms of what keeps me up at night, there are many things that keep me up at night. And from an individual position perspective, just ensuring that we focus on things that are really orphan, where we understand what the drivers are, why the opportunities exist, and really understand that we're operating in an environment that might not be fundamentally driven.
So stick to your process and proceed with extreme caution.
Exactly.
Aaron, you've been in the business for so long. Can you tell us who were some of your mentors? What have they taught you? What lessons can you apply in your work today?
I was very lucky to have great mentors over the years at each of the firms, even starting out at Credit Suisse and leverage finance, but going all the way up to my long experience at Fairtree, being able to work with Jeff Tannenbaum, Andrew Fredman, David Sultan, folks that really built one of the true opportunistic investment firms. It just helped me out so much. And I think one of the things I have, my 11 lessons learned from Fairtree sitting on my desk. And number one is up, down is everything. And I think the thing that I learned from Jeff and Andrew and David is it's very hard to predict outcomes. Many folks like to look at expected return. But if you focus on what are you paying for a specific security and ensuring that the downside is very limited from a perspective of the range of possible outcomes, even if you're going to get plenty of things wrong, right? So even if you have a number of names in the portfolio that you get wrong, you still should be able to make a significant amount of money if you ensure that the situations you focus on have very limited fundamental downside. So we always remind ourselves at Converium, up, down is everything. Focus on how much can we lose if we're wrong, and because we're going to be wrong, and how much can we make if we're right.
Right. It's not about chasing returns. It's
exactly
downside protection. So, Aaron, you've been a co-organizer of the Sohn conference in Montreal.
Yeah.
Can you tell us a little more what this event is about, and sort of your philanthropic activity there?
Sure. I think it's so important to be able to give back. And we're fortunate enough to be able to we have a lot of blessings, a lot of things we can do, and was fortunate enough to learn about the Sohn Conference Foundation and all the good work that the Sohn family has done over many years to use Ira's legacy to support many pediatric cancer research and other pediatric health-related causes. I was asked to speak at one of the Sohn conferences over 10 years ago, and to marry the desire to do well for others and to give back to the community with sharing investment ideas, which obviously I'm very passionate about, I think was beautiful, and really wanted to share that with the Montreal investment community. So got a bunch of folks together, and then in May of last year, we hosted, in May of 2025 rather, the first ever Sohn conference in Montreal, which was a great success, raising over $1 million. Most of the money went to not just the Sohn Conference Foundation, but also the 2 leading pediatric hospitals in Montreal. And we're very excited to be doing it again this year in June of 2026.
As a former hospital employee myself, I can certainly appreciate your contribution to that philanthropic effort. Thank you for that. The last event was a great success. I certainly look forward to attending the next one.
Thank you.
Well, Aaron, thank you so much for speaking with us today and sharing all your thoughts about markets and explaining about Converium. It was really a pleasure to have you.
It was my pleasure. Thank you so much.
Thank you. For more interviews, subscribe to our YouTube channel.